In today's video, we will be talking about compound interest, which we will explain in a simple way for beginners to understand. By the end of this video, you should have an idea about how compound interest works and how to apply it to your investments, as well as how it indirectly affects your wealth through fund management. This is something you should absolutely be aware of, and we will show you an easy rule of thumb on how to calculate the doubling time of an investment at a specific interest rate. Also, stay tuned if you want to know how many days it takes to reach $1 million if you start out with $1 each day. Let's begin. Compound interest, or interest on interest, is this almost magical thing that you need to use to get your investments to grow. How much money do you keep in your savings account when investing in stocks or in any other way? Where do you get interest returns on your investment? This is one of the most basic concepts that you need to understand when investing. When you invest, you need to make smart decisions for your personal finances and take control of your future. We should all have learned about this earlier, as the time invested is the most important factor for the end result. There is a good reason why Einstein calls compound interest the eighth wonder of the world and the most powerful force in the world. Who are we to argue against one of the most intelligent people in the world? When it comes to compound interest, let your investments and savings grow by themselves while you sleep and eat. To understand compound interest, you have to first understand simple interest. Let's meet two people, Matt and Abby, who are both in their 30s and want to invest during the next 30 years of their pension. Matt has $1,000 to invest, and with this money he will get a 10% interest rate, which is equivalent to $100 every year. Matt withdraws the interest but keeps the $1,000 after 1 year. Matt receives $100 in interest after a year. His total is $1,100 after the second year, and another $100 in interest. So by this time, he already has $1,200 total. You guessed it, didn't you? In 3 years, he'll end up having $1,300 after his $100 interest. 30 years later, Matt now has $3,000 worth in his investment and is still earning $100 in interest every year during those years. In this example, as he withdraws the interest every year, he doesn't get compound interest. All in all, he is able to get $4,000 in 30 years. Now let's see what happens on Abby's side. Abby has also invested $1,000 the same way as Matt did, and she also gets the same 10% interest rate on her investment each year. But instead of withdrawing the interest each year like Matt did, she leaves the money invested and get compound interest. In the following year, she gets $1,000 in interest, similar to Matt, and when another year has passed, it's time for money to grow again. 2 years later, she received $110, which is 10% of the money she accumulated after the first year. She has $1,100 in the first year and now has $1,210 after 2 years. 3 years later, she is still receiving interest. After the third year, she is getting 10% of $1,210, which is $121. And now she has $1,301 in total. As time passes, the interest amount increases each year, and Abby not only gets interest on her initial investment, but also the interest that she earned in the previous years. The interest is compounding. With compound interest, Abby's investments are able to grow exponentially. As she accumulates more interest, the faster her investment will grow. Time will become your best friend in this situation. You can see this clearly by looking at how fast $1,000 is earned after 9 years. The first $1,000 doubled to over $2,000, and it goes even faster. It takes only 4 additional years for the investment to grow into 3,000. And after that, $4,000 is reached in less than 3 years. It grows faster and faster since more wealth has been accumulated. Matt does not get the same snowball effect since his money grows linearly, and it takes the same amount of time to grow his investment from $1,000 to $2,000 as it does from $2,000 to $3,000 and so on. There is a rule of thumb that you can use to quickly calculate the doubling time of an investment at a specific interest rate. The rule of 72 says that you can obtain a doubling time for an investment by dividing it by 72 with the interest rate as a percentage. Without taking into account taxes, it'll take you 72 years divided by 1 to double your money. In reality, you will end up losing money at this rate due to inflation, since it is higher than 1%. Your money will lose its buying power. With a rate of 2%, which is equal to inflation rate nowadays. It will take up to 36 years for the investment to double. And with 10 interest rates equal to the stock market's yearly returns, it'll take 7.2 years. To not lose money, you have to invest at a higher interest rate to understand how powerful compound interest can be. Imagine that you start with $1 and then double your money each day. On the following day, you will have $2. On the third day, you will have $4. And on the fourth day, you will have $8 and so on. Do you know how long it'll take to get to $1 million? Did you know it would only take you 21 days from now on? It may seem unrealistic to think that you can double your money every day if you don't go to casino and have an immense amount of luck, but this shows how powerful compound interest can be. The amount of money that you can accumulate depends on the interest rate. The principal and the time invested in the money will naturally grow faster with a higher interest rate. Don't forget that the higher the interest rate, the higher the risk is for the initial investment. This is important to take note of, but it is not as important as time. Let's take a look if you don't have as much time as Abby did, but still want to reach the same amount in the end. You have to start with a higher principal if you invest during those 20 years instead of 30. For the same result, you need an initial investment, which is the same thing as principal, of $2,600, which is 2.6 times more. And if your investment horizon is only 10 years, you need a principal as high as $6,700. If you are young, then time is on your side, and it can be worth investing even in smaller amounts. If you are a bit older when you start investing, then if possible, it would be worth trying to invest a larger amount. But even small amounts will be able to grow with compound interest and make a difference in the end. We are asked if compound interest only works with savings accounts, but it also works with any investment where you get a return. An example could be stocks or bonds if you want to invest with compound interest. The whole concept of compound interest includes saving and investing instead of receiving immediate rewards. It's interesting to consider how much immediate consumption would be worth in the future instead of buying coffee on the go for about $5, which would be equal to 80 in 30 years, because of a 10% compound interest rate. Ordering lunch for around $10 the same way may be worth almost $160 in 30 years because of compound interest rates. We are not saying that you should never buy coffee or lunch, but it is good to be aware so you can make smart economic decisions and have control over your consumption and investing. Even if you don't buy coffee often, buying coffee once a week in 1 year will cost you $260. And this may seem like not a lot to you in 1 year, but after 30 years, it could cost you $4,100 instead due to the compound interest considerations. Another example of when compound interest has an effect is when looking at management fees for funds. It's easy to be fooled into thinking that a management fee of 2% does not matter that much. The difference is just a small percentage, but with compound interest, this difference will grow larger as more time passes. The management fees accumulate into a larger sum, and the fee also decreases your invested sum, which can compound new interest in the coming year. Let's take a look at the example of Abby again. In the first round, we didn't take fees into consideration, but imagine she invested with a specific management fee percentage. The fee of a mutual fund is commonly around 1 or 2%, and for index funds, the fee is lower, usually before 0.4%. Hedge funds can have even higher fees, 2.5% or more, and different performance-based fees. It's even more fun when it gets to take a greater fee if it beats its benchmark index. And it also exists if you're not familiar with the different fund types. Follow our channel and click the notification bell icon to see more of our personal finance and budgeting tutorial videos. If you have friends or family who need some help in their personal finance journey, go and pass this video along. Don't forget that the secret to success is to have a continuous pursuit for knowledge. This is Legend Finance. Thank you so much for watching our video. We will see you all again in our next video.